As U.S. stock markets push to record highs, a familiar seasonal phrase is back in the spotlight: the Santa rally. Traditionally used to describe the tendency for stocks to rise in the final weeks of the year, the Santa rally is often dismissed as a feel-good market cliché. But this time, the rally is happening against a complex economic backdrop that makes it worth examining more closely. Record high markets are not being driven by holiday optimism alone. They are being fueled by a specific combination of macroeconomic signals, investor psychology, institutional behavior, and expectations about what comes next. One of the strongest forces behind the current rally is expectations around interest rates. Markets move less on today's conditions and more on what investors believe will happen next. As inflation data has shown signs of cooling and economic growth has remained resilient, investors have increasingly priced in the idea that the Federal Reserve is closer to the end of its tightening cycle than the beginning of another. Even without immediate rate cuts, the belief that rates are no longer rising aggressively has reduced uncertainty. That shift alone can drive equity prices higher, especially in growth-oriented sectors that are sensitive to borrowing costs. Another major driver is earnings resilience. Throughout the year, many analysts expected higher rates to significantly compress corporate profits. While margins have faced pressure, overall earnings have held up better than feared. Large U.S. companies, particularly those with pricing power and global scale, have been able to manage costs, pass through price increases, or streamline operations. When worst-case earnings scenarios fail to materialize, markets tend to reprice quickly. The rally reflects relief as much as optimism. Investor positioning also plays a critical role. Earlier in the year, many institutional investors stayed cautious, holding higher levels of cash or defensive allocations. As markets continued climbing despite skepticism, that underexposure became a risk in itself. Fund managers are measured against benchmarks, and missing a rally can be as damaging to performance as betting incorrectly. As the year-end approaches, portfolio managers often rebalance to avoid lagging peers. This performance-chasing behavior can amplify upward momentum during the final weeks of the year. Seasonality adds another layer. The Santa rally effect is partly rooted in lower trading volumes. With many market participants stepping back for holidays, price movements can become exaggerated. It takes less capital to move markets higher when liquidity is thinner. Combined with a generally positive tone, this dynamic can push indices upward faster than fundamentals alone would justify. While this does not explain the entire rally, it helps accelerate it once momentum is established. Retail investor sentiment has also improved. After a period of caution driven by inflation fears, banking stress, and recession headlines, many individual investors have gradually re-entered the market. Rising account balances reinforce confidence, creating a feedback loop. When markets make new highs, it attracts attention, media coverage, and inflows from investors who previously stayed on the sidelines. This participation broadens the rally beyond purely institutional activity. Another important factor is the concentration of gains in large-cap stocks. Much of the market's upward movement has been driven by a relatively small group of highly profitable, cash-rich companies. These firms benefit disproportionately from stable demand, global reach, and strong balance sheets. Investors often gravitate toward these names during uncertain periods because they are perceived as safer growth. Their outsized influence on major indices means that strength in a handful of companies can lift the entire market. Macroeconomic data has also supported the rally by defying extremes. The U.S. economy has avoided both runaway inflation and a sharp recession. Employment remains relatively strong, consumer spending has cooled without collapsing, and credit conditions have tightened without freezing activity. This soft landing narrative has gained traction, encouraging investors to take more risk. Markets tend to perform well when economic outcomes land in the middle rather than at the extremes. Tax-related dynamics contribute quietly as well. Toward year-end, investors often complete tax loss harvesting earlier, selling losing positions before December. Once that activity winds down, selling pressure eases. At the same time, some investors deploy capital to rebalance portfolios or prepare for the new year. This shift in flows can create a favorable supply-demand imbalance for equities. There is also a psychological component that should not be underestimated. Markets are forward-looking but also emotional. New highs create a sense of validation. When major indices break records, it reinforces the belief that the market is healthy even if risks remain. This optimism does not mean investors believe everything is perfect. It means uncertainty feels manageable. That perception alone can sustain rallies longer than fundamentals might suggest. Importantly, this Santa rally is not driven by a single narrative. It is the result of multiple overlapping forces aligning at the same time. Rate expectations, earnings stability, positioning pressure, seasonal liquidity, and psychology are all reinforcing one another. When these factors converge, markets can move higher quickly and persistently. However, record highs do not eliminate risk. Valuations in certain sectors are elevated, and future gains will depend on whether optimistic assumptions continue to hold. Inflation could reaccelerate, economic growth could slow, or policy surprises could disrupt sentiment. The Santa rally reflects confidence in the near-term outlook, not a guarantee of smooth conditions ahead. What makes this rally notable is not just its timing, but its context. It follows a period of intense uncertainty where many investors expected volatility to dominate. Instead, markets have chosen momentum. That choice reflects belief in adaptability, in the idea that companies, consumers, and policymakers can navigate challenges without triggering severe disruption. In the end, the current Santa rally is less about holiday cheer and more about recalibrated expectations. Investors are no longer pricing for crisis, but for continuation. Record-high U.S. stock markets are being driven by relief, resilience, and repositioning as much as by optimism. Whether the rally extends into the new year will depend on how durable those assumptions prove to be. But for now, the Santa rally is delivering exactly what markets tend to reward most at year-end: confidence that the path forward, while imperfect, remains navigable.